Let's have a look at this table, Vodafone from 2002, and have a look at the turning points. So we start at the bottom, October. Now we've got the open, high, low, close. We've got the high-low range and we've got the open-close range, which we calculated on a spreadsheet. And then if you look, this is for the dailies for Vodafone. So we start in October 2002. The close was 103. Then we sort of go up to 106. But we noticed that the open-close range has turned negative. So we say that's a short signal if you trade in spread betting or CFDs. And what happened when this signal came, the next day it went down, 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 and then it started to go positive. But when it got to 0.27, it gave a long signal, and of course it jumped back up. And then we got a minus 5.9, which would then be like a short, and it did actually indeed go down. And then we got a 0.16, which we would consider similar to this, a long signal, and it did, the price went from 113, 116, 118, and then we got the minus 2.85, which is a short signal on the open close range, and indeed the price went from 118, 17, 16 until we got to 0.3, 0.96, which is a long signal. And indeed the price did jump up to 126, but then the open close range went negative again, indicating a short signal. So if you'd have gone short, what happened to the price? It went from 126, 124, 119, and then stopped and jumped up a couple of points, shall we say, and then it went, the open close range went negative again, which would indicate that, and then it went negative again, but it wasn't your 0.96 or your 0.16. So it did indicate like a short, but the price actually went up for a couple of days from 121 to 123, giving sort of a false signal. And then, but then this would have indicated a short, and that indeed it did go down for a day, and then it came positive, and then it went back up. So you can see that by doing these innovative types of calculations on the high-low range and the open close range, you can work out what the turning points are, which gives you high probability trades, especially on a very short few day time frame. And it worked quite well with this method for people who wanted to, in those days there weren't any high frequency trading, so it was a lot more gentler market. And of course it was a bear market in 2002, which was especially on the indexes, and people did make quite a bit of money or maybe not so much money, but they made money because of the falling prices. So it's quite interesting to do this kind of innovative research on different stocks, indices, forex and stuff, and see if you can find different patterns using these high, low range and the open and close range. So this gives you an edge in the market because nobody else has thought of this sort of thing. Nobody in the last 20 years has ever done anything like this. So it can give you an edge in the market. So it's interesting to do your own innovative research on price action so that you can find the turning points. So I hope this is of some value to someone. Till next time.